Inflation in the US is taking center stage, with rates persistently hovering above the comfortable 2% target. The consumer prices continue to climb, driven by escalating housing and fuel costs. The numbers are in, and they paint a picture of a battle between the economy and inflation that's far from over. The rising tide of inflation is being fueled by two key factors: housing and petrol costs. Housing, the cornerstone of the American dream, has become a significant contributor to the rise in the consumer price index. With costs soaring, the dream is becoming increasingly elusive for many. Simultaneously, petrol prices are also on the rise. Every trip to the gas station is a stark reminder of the increasing costs. These escalating prices, although slower than housing, add an extra layer to the inflationary pressure. But it's not all doom and gloom. Some sectors are experiencing a drop in prices. Used cars, once a symbol of the surging inflation, are now seeing a decrease in costs. The fashion industry too is breathing a sigh of relief as clothing prices fall. Moreover, the increase in grocery prices is showing signs of slowing down. In response to this inflationary pressure, the US Central Bank is mulling over a potential solution: raising interest rates. This move aims to stabilize price growth, which is still soaring above the 2% target. By raising the borrowing costs, the Federal Reserve hopes to encourage saving and reduce business expansion. This strategy is designed to cool the economy and alleviate price pressures. However, the road to economic stability is a long one. Even as inflation has cooled from last year, it's still stubbornly above the Federal Reserve's target. Officials are bracing for a future where rates stay relatively high for some time. As we look ahead, the question remains: how will we navigate this inflation situation? As inflation continues to surge, it's affecting everything from wages to mortgage interest rates. Let's delve deeper into how these two areas of our economy are being impacted. Inflation is a double-edged sword when it comes to wages. On the one hand, we've seen the annual state minimum wage increase in 23 states, a move that will boost pay for an estimated 8.4 million workers. This is a significant step towards financial relief for many. However, the larger increases in minimum wage come in response to inflation hitting a 40-year high, causing families to struggle with rising costs. While wages at the low end have increased faster than inflation, the minimum wage has become less binding as many workers are already paid above it. The wealth gap in America has been highlighted by the pandemic and subsequent economic recovery, leading to increased labor movement activity and wage increases by large corporations. Yet, the labor market imbalance caused by the pandemic has resulted in worker shortages and pushed up average annual hourly wages. On the mortgage front, the story is a bit different. In September, the average interest rate for a 30-year fixed mortgage was 7.07%, while rates for 15-year mortgages averaged 6.35%. The average monthly mortgage payment for a 30-year fixed mortgage is currently $2,823. These rates are influenced by factors such as inflation, the bond market, housing market conditions, and Federal Reserve policy. While rates fell in 2020 due to the impact of the pandemic, they began rising again in 2022. Forecasts suggest rates may start dropping again towards the end of 2023. The federal funds rate, controlled by the Federal Reserve, affects mortgage rates. With wages struggling to keep pace with inflation and mortgage rates potentially hitting 8% this year, the financial strain on households is mounting. Despite the current inflationary pressures, market analysts believe inflation is likely peaking. As we navigate the economic rapids, let's remember that the river of finance is ever-changing. Forecasts from the likes of Morningstar, the International Monetary Fund, and the Federal Reserve suggest a return to normal inflation levels by the end of 2023 or the beginning of 2024. Investors, however, are expecting slower rate hikes, with a 50 basis point increase predicted for this September. While this might seem like a slow pace, it's a necessary caution in the face of potential economic turbulence. As we look at the housing market, rental costs have grown at their fastest pace in over 3 decades. This is driven by a lack of supply, increased demand, and the end of rental assistance programs and eviction moratoriums. It's a tough situation for renters, many of whom are facing difficult choices between affording shelter or other necessities. Despite these challenges, traders believe that a recession in the United States is somewhat to highly likely, with 74% anticipating it to begin this year. This might sound grim, but remember that economic downturns can also present opportunities for growth and innovation. While the road to recovery may be long, there's hope that the worst of inflation might be behind us. As the inflation saga unfolds, it's essential to stay informed. The economic landscape is a complex, ever-changing tapestry that impacts our daily lives, from the price of our morning coffee to our mortgage rates. Knowledge, as they say, is power. Being aware of these shifts and trends equips us to make informed decisions and navigate these financial tides with confidence. This channel is dedicated to providing you with up-to-date, insightful analysis on the global economy, breaking down complex concepts into digestible information. But we don't want this to be a one-way conversation. Your thoughts, your experiences, your insights matter. So let's make this a dialogue. Maybe you've noticed the price of your favorite brand of coffee creeping up, or perhaps you've been impacted by the rise in rental costs. Whatever your story, we want to hear it. By subscribing to this channel, you'll not only be kept in the loop on the latest economic developments, but you'll also become part of a community of curious, engaged individuals just like you. So don't be a passive consumer of information. Engage with us, share your thoughts, ask your questions. The comment section is your platform to voice your observations, your concerns, your predictions. Join the conversation by subscribing to this channel and sharing your thoughts in the comments section. Stay informed, stay ahead.